question. Great.
So in terms of an expensive drug like this Hep C drug, are you finding that paying for the cost of a drug like that in the long run costs less than what might happen with that condition going forward? Or, you know, is paying for $84,000 a month for a Hep C drug more expensive than what might happen to that patient down the road?
Yeah, I'm not sure if any of us up here are qualified to answer that. I don't know. I know
Beata
I'm not.
probably is.
But we do have somebody in the room that might know a little bit more about this. Magellan people are here, the RX vendor, pharmacy benefit manager, and that's, I'm sure they've seen probably more of this than any of us have seen right now.
Sherry in the back, Sherry Caruso, wave to everyone. Magellan, talk to, there's Chris too, and Robin. Wait for the mic. Run, Holly.
So what I would comment on is that if it's as Tom said, 92 or 93% cure rate, you're basically effectively taking off a liver transplant off of your plan. Therefore, I think it's a good thing, not because I'm selling the drug. I think it's because long-term care, you're keeping people healthier and out of the hospital. Because
you're not selling the drug, right?
Well, yeah, we do sell the drug, but I don't sell it personally, obviously.
But I understand that this condition can be in remission for quite a long time. So it all depends who's going to seek the treatment. People that figured, well, it's enough, I don't want to have this condition anymore, or people that actually are going to be claimants in the next 36 months, you know. So, but that just means that we're going to incur higher expense now, but ultimately, I mean, we are taking a disease off the table, so I think that's good. But I think, you know, clients in this room, you need to make sure you do choose the right stop-loss carrier, because if you know, you intend to cover those drugs, and all of a sudden somebody, you know, has a policy that does not mirror your plan document, you want to make sure that it's clearly transparent to you, so there are no surprises.
All right, I have two more questions for you, and then if anyone else has any other questions. Oh, we do have, there, fine, there you go. Well, you gotta wait for the mic, see, now Holly's hustling.
Hi, I'm from California, and in the 50 to about 200 size group market, we're seeing a lot of the level funded product that Cigna kind of brought on board, and now we have United Healthcare and some of the other carriers. Can you guys comment as to if you guys get involved in level funded versus the self-funded plans?
That was one of my two questions.
Montgomery Management, yes, this is a product we have that goes down to 10 lives, and we're now seeing some activity in California. The biggest thing the difference between our plan and like the Cigna plan or Star Marks is that if you don't use that claim money, it all comes back to the employer. Cigna's, they capture some of that money, and so does Star Mark and all the other carriers, or most of the other carriers that are doing it on a carrier direct basis.
And Chris, can I just interrupt real quick, just for those uninitiated in the room? Level funded program by Cigna, for example, refers to a program wherein you are a self-funded entity, but you're paying to the max, essentially. You're required to pay like premiums or premium-like amounts. So it kind of looks like a fully insured plan, except it's self-funded. And we've had great success in selling against the Cigna product in particular, because as Chris just said, if you're funding to the max and your claims are only, 30% or 40% below your max, Cigna keeps a third of your money, in some cases 50% of your money at renewal, and then allows you access to the cash that you had paid yourself but didn't spend in the form of premium credits the next year. So rather than the model that we have, which says the money's yours, you have to fund it to the max, but if you don't spend the money, then it stays in your bank account.
Yeah, we require that our contract's at 12/21, so we keep that money for an additional 9 months to make sure the runout's paid. But if there's a significant amount, we work with the TPA and the client and the broker to release some of that before that if we think the runout's been handled. Yeah. As long as there's a hold harmless letter signed saying that you understand that if there was a claim to come up, you might have to give that money back before the end of the 9 months.
You go down to 10 lives, but what is your sweet spot?
Honestly, our sweet spot, I do have some at 10 lives, believe it or not. I never thought we would, but we do. and they're so far good. But I would say probably 35 to 75 lives is our sweet spot right now on that product, and it's really going quite well. We haven't done much out west as I'd like to, but we're working on that.
It's becoming popular because now United Healthcare has their All Savers plan
Yeah.
as well.
And the thing about these Cigna, and if you leave, they keep all your money. So Cigna, Starmark, if you happen to leave us, you still get your money back.
All right, who else wants to talk about that? Here's your opportunity to sell your new products.
I was going to say, kind of like Chris in Montgomery, we have a level funded option as well. Full return on any unused cash reserve at the end of the plan year as well. And I think in my eyes, the reason I like the level funded products as much as I do is because, number one, it's a big piece of education for the group, just kind of getting them to understand self-funding from a very base level versus fully insured. And I kind of see it as a short-term vehicle for the group, and ultimately flipping them over to more of a traditional spec and ag model after 3, 4, 5 years, what have you. That being said, we have had cases on our level-funded programs for 5, 6, 7 years. They just like the model. They're running well. Loss ratios are great. They like getting their reserve at the end of the year, and they're comfortable staying where they are. But in my eyes, I do see it as like a 2 or 3 year flip them over to traditional spec and ag.
And I think to dovetail on what Tom said, you can, if the attraction to the level funded is being able to fund to a number and knowing you're never going to have to dip into your pocket again on a monthly basis, so that it looks and feels from a cash flow basis like a fully insured plan, there are traditional spec and ag products out there that can accomplish that same goal with cash advance on the specific side and properly structured aggregate accommodation. If the plan funds to the maximum, you can say to the employer, you will not have to dip into your pocket again on a monthly basis.
Right. And I think the reason this product has gained such popularity is because for years and years and years, these size of employers have been told, you're way too small, you're way too small. So they're scared. So this gives the TPA and the broker an opportunity to deliver a product where they're not worried about anything over than what they would pay the fully insured carrier. And they can also get the tools during the plan year when you make your quarterly or your 6-month meeting to show them, here's how this works. It empowers, knowledge is power. And so these things help these employers then understand, and after a few years they roll in traditional. And as my cohort here said, there's all kinds of products to do that. They just don't all go down to 10 lives.
All right, we've got another question.
Tom, you're going to have to my memory here, but one of the previous Cypress used a panel just like this with the reinsurance companies. One of the distinguished guests made a statement that it told us, the employers, that we would expect our specific premiums to increase 200 to 400%.
Who said that? Does anyone remember? I don't know.
Nobody's going to fess up to that, but I'd be curious if you see any of that trending in the future.
No, I tell you, it's trending. I was in a panel not long ago, and somebody asked panelists, and we actually represented all large carriers, what was your largest claim? And 4 out of 5 said around $4 or $5 million. And because all of us are taking about $5 million of liability, we didn't pass on anything to the reinsurer, where folks are not necessarily in that spot. So as the claims come up, they will be laying it off to reinsurers. And as their costs come up, they're going to pass it on back to you. Now, somebody did mention that I think it was Aetna that had a $12 million claim. It was a burn victim, 1 year. One would wonder how many claims can you rack up in 1 year, $12 million. And somebody in the room actually said that they were involved on the reinsurance side, and they were kind of, did not have a happy look on their face about that. But the claims are going up. I mean, we did some study with competitors on our own and industry. Our $500,000 claims neutralized to 100,000 employees went up 55% since 2009. $750,000 claims went up 67%, and $1 million claims went 110%. Wow. And if people in this room or this table say that it's not so in their books, industry-wide, at SIA and other organizations, that is the trend. Trends, the claims are becoming larger, and I think as TPAs and folks that are involved with facilities and reimbursements, as providers see that there is no ceiling, they will start passing that buck down. And as the Medicare pricing becomes Medicaid pretty soon, there will be greater push towards the private insurance. So do we think that the trends are going up? Absolutely. But as an industry, I think I can speak, we participate in surveys, our average rate increase over the last few years was around 18%. All my competitors, because we can actually check in rates filing states what their rate action was, and it is very much in line with what ours was. So does it mean that somebody didn't get a 40 or 50 or 60%? I'm sure, but on the average, on a $770 million block, we delivered 18. Is it sustainable? Not if we see those claims come in. We had 2 double lung transplants, 2 years apart, $2.5 million each, our cost. It's going to happen.
Yeah, and one of the things the ACA did not address, and I think we all know this, is the cost. And I think there's going to be a speaker here tomorrow from AMPS that has some alternatives to that. And I'm just going to say it publicly, I think PPOs, at the beginning of the death of PPOs is happening right before us, because unless this country figures out a way to limit the liability on claims cost on a generally level playing field basis, it is unsustainable on the claims side. I mean, individual claims are always going to be able to be addressed with premium over a block of business, but claims costs on the aggregate side, aggregating those costs without some kind of protection for the employer and the employee, right now there's no ceiling on it.
All right, so just a couple of minutes, and I just, before this, and it just popped into my head, so I'm going to say this while I remember it. Lots of interesting discussions about these kinds of things, and there's so much that these people are talking about in terms of the depth of knowledge. I got my note from a corporate headquarters that said there may be people out there in this audience, with all respect to everyone in the audience, who may not know what a 1212 or a 2412 is, or a level funded plan. There's an opportunity to learn. I think it indicates in your agenda that tomorrow at lunch, each of these individuals are going to have their own individual table. You can talk to them about it. Find someone with a Cypress University logo, or sales and service people. They can kind of give you a sort of stop-loss 101 as well. So last thing before we break, I thought maybe this would be a good opportunity to kind of start from Kurt and go down the table and tell everyone here, what do you got, what's new, what are you rolling out, what kinds of products or services should people be talking to you about?
We should be out of here by 7:30.
I think we'll be out of here well before 7:30.
Now,
we may still be talking, but
well, exactly, to an empty room like I do at home. We're a small group stop-loss underwriter. We focus on groups from only down to 15, so not 10, but 15 lives and up. And our sweet spot is everything below 100, although we'll look at them as big as they come. We've consistently been in that marketplace since 1990. We have designed our products and services to cater to the small employer, specific advance reimbursement, aggregate accommodation, all those typical bells and whistles that everybody has. But we also we were one of the early adopters of the level-funded product. We call ours integrated stop-loss. And we've had some wonderful success with that. We are able to, if you've got a concern about risk moving forward, we can answer it in one way or another, whether it's through a specific or an aggregate terminal liability product, whether it's through a no laser renewal with a low rate cap for a low charge, those kinds of things. But what I think here's what's important to us. Finding the right TPA. You all are very lucky in this room because you've found it. Every TPA says that they can manage claims rather than just pay them, but I can tell you that not all of them can do it well. Cypress does it well. And just as you as employers care and you want your employee to care beyond what their deductible and coinsurance and copays are, because now they're getting into your pocket, We want you as an employer to care beyond your specific deductible because you're getting into our pocket. And Cypress does a wonderful job of making sure that everybody is protected and that everybody is looked out for and tries their best and does their best and achieves their best by managing that claim down to the absolute lowest possible dollars. So anyway, thanks for picking a great TPA and thanks for inviting us here.
There you go. All right, keep going. I love that. Feel free to say good things about us if you want.
Yeah, it is very true. I mean, about the TPA, finding the right partner is very important. We underwrite a TPA, we underwrite the broker as much as we underwrite a case. That's, you create blocks of business with people, you create leverage, then the phone call happens, help me out, and we can help people out. Even though, unlike my competitors here, we have the best contract in the market. 5 exclusion contract. But it is very important to have the right partner. The TPA is the conduit to the PPO, what's happening right now in the industry, and that's one way that we're going to be able to embrace the claim cost, escalating claim cost, is by narrowing the networks. There's a lot more variation in the marketplace. Now with the multiple options, there are narrow networks that offer less viability, but also offers a much greater claim cost reduction. And they're wrapped with a PPO network that may be a little broader and then an outside coverage for out-of-network participation. Also, the larger claims come from out-of-network. So as much as we, from underwriting perspective, network access is very important. That's why, the narrower the network, the more cost containment you're going to see. But having control over the out-of-network claims, the pregnancy that happened over the weekend that all of a sudden you don't know about until 31st day and the child has to be enrolled and you find out that this pregnancy have happened, that's where the TPA comes in. They'll be able to connect you to the right people, whether they manage the claims themselves or find the right vendors for you. But that's the value proposition of being self-funded. And then I will plug ourselves. We do have an MLP product. It's a fully insured to self-funded transition product. We also, not only we offer fully funded product, but we also give a maximal liability. So we guarantee that second year we will not increase the cost by more than 30%. Of course, we can lower it, but maximum is 30. So that's one way of dealing with gentlemen in a gray shirt. One way of dealing with lasers, by having caps of some sort year 2, you are in fact lowering the ultimate cost. Is it our go-to product in the future? No, my sweet spot is a little bigger than that, but it's certainly, as we call it, transition product, will help people gravitate towards self-funding, and a couple years from now they're going to go straight up stop loss. So, but just to finish briefly, we are trying to put a lot of effort in finding more granular way of pricing a product. There's a variation between, everybody in this room are giving a PPO discount to a network, but we don't know if the hospital A is getting 30%, hospital B is getting 10. We kind of average it out, and we believe as underwriters in our company that going forward, the last man standing will be the one who has the most accurate data. So we're putting a lot of effort into this granularity in each state, understanding what makes utilization migrate and what makes hospitals, how they're charging and being reimbursed.
All right, new rule, 60 seconds or less.
That's
I'm
gonna,
the only
that's
woman.
gonna be tough
I guess
for me.
I thought it was
There are cocktails waiting,
I'll try to make this short and sweet as I can. But not to beat a dead horse with these two just mentioned, but finding the right partners is absolutely critical. You definitely struck gold with working with Cypress, but if you get the right TPA, the right stop loss partner, and the right broker, it can really be a trifecta of success for your clients. They're going to be on a self-funded model. Like everybody else, basically, we do have a wide array of level-funded options. We also have an aggregate only, which is another good way to get smaller groups. So we're talking 25 to maybe 150 into self-funding, kind of dipping their toe in the water. ECU is also right in the middle of building our own captive program. I can't speak publicly to a lot of the intricacies and details of that program just yet. This conference was, maybe a month down the road. I could absolutely, but if you want to talk about that, come find me on the side and I can give you some details. But we're going to be formally rolling that out within the next month or two here. Another thing that we're doing is getting a concrete way to price reference-based programs, so your Medicare and Cost Plus programs. We're in the final stages of developing that. It's definitely a hot ticket item out there as well. And another thing we love to do is offer our broker partners a way to accurately assess the risk for their cases, smaller cases that don't have any claims data coming off fully insured. So, your 25 to 100 lives, or in California case, I guess 250 and below, through individual medical applications that we do online, and we'll actually give you a self-funded risk assessment and kind of say, hey, on a scale of 1 to 10, here's your risk, and that way it'll give you an idea of the programs you need to put in place for that self-funded plan to be successful, whether it's wellness, different cost containment initiatives that Cypress has a wide array of. So we'll help guide your hand.
All right, so I gave him 60 seconds. He took 120. I'm going to give you 14 seconds, Rob.
Yes. So everybody's been saying it, but Cypress is certainly one of the better TPAs in the country. We work with many TPAs, and we assign them a tiering of premier, and Cypress is one of those premier TPAs, so hats off to Cypress and what they do for you and your clients. Regarding Optum stop loss, I'll look back. I'm not going to take that long, Chris, seriously. Okay. Okay. So Adam was up here before talking about the exclusions that you should not have in your stop loss contract. We don't have any of them. The gauntlet was thrown down regarding exclusions. They have 5, we have 3, so booyah. And then regarding, I touched on it before, regarding we do have a refund product regarding our stop loss. So when they have a good year, they get money back. We also have a cap program, so if they have a bad year, they're protected. Good year, they're rewarded.
All right. Montgomery Management is a wholly owned subsidiary of Companion Life. We are their largest managing general underwriter. They are managing with us over $600 million of assets, and we are the shit in stop loss.
That's what I was looking for from everybody.
At least
good
they
luck,
have a
Pete.
guy working there that's been there since the beginning of stop loss. Maybe internet. No, I think that one was already claimed.
Yeah, you can go.
Cypress is great. We have a great program to get MEC programs, skinny programs out there where you can quote a bronze plan, a gold plan, and a MEC plan all in the same stop loss policy, spec and ag coverage, and then ag only coverage for the preventative services, number 1. Number 2, we have a great transplant product. It's self-funded, partnership with Cigna. So you can choose a spec deductible rather than pay the fully insured premiums to carve out that risk. And number 3, captives. IHC has been in captives for the better part of 3 years. We think one of the more robust programs in the country. If you have interest, love to talk to you about it. Thanks.
International Medical Group is a multi-line underwriting organization. In addition to medical stop loss, we underwrite a full portfolio of international medical and travel insurance products. So we have a wide range of experience in underwriting. I tell people we are an equal opportunity stop loss underwriter in that we will write all size groups. But like a few others here, we've been doing small group for a fairly long time. Since our inception in 1998, we believe that the opportunity that has been created for the smaller employer to be self-funded by virtue of the Affordable Care Act is huge, and that is an area where there's great opportunity for employers to manage their plans and save money. Cypress does a great job of managing cost. IMG does a great job of managing the risk, and we have a great deal of flexibility in how we manage that risk with you in terms of covering all the what-ifs. The laser, non-laser issue, we have products that guarantee not to laser, have a maximum rate increase. We have a variety of options for covering your run-out liability, so we've got all those bases covered.
All right, great. Thank you to the panel. This was great.